So, hello, and a massive hello to everybody. Hope everybody's having a great day wherever you are, whatever you may be doing. 50 pips, rocking and rolling here. No trade calls, no recommendations. Everybody's responsible for their own stuff because we're here for educational purposes only. So, welcome. As usual, no real agenda, nothing specific I want to discuss. Just trying to do these to pay it forward every month or so. And so, again, feel free to ask whatever you want to go through. As usual, if we get people live, there should be a decent stream of questions so we can tackle whatever anybody wants. If not, I'll just do a little bit of a general review of the market and then post that. As usual, if you're listening to these, I would appreciate it if you could just like them or just to let me know that they're useful. I try and do them even if nobody shows up just to put them up, but it's always interesting to see if people actually appreciate them or if it's worth my time or not. So here, first of all, of course, Happy New Year to everybody. Let's see what's going on and let's see what happens. So we're into January trade. January, famous for getting people in trouble, being a little bit of a messy month. Usually the month doesn't really start until we get through MLK weekend, right? So remember, this week is a full trading week, but next week is a 4-day trading week because Monday's a holiday. So usually the markets likes to stop everybody out of the best trades of 2024 that were published in December in the first 2 weeks of January, and then the year can start. As always, I don't make the rules. That's just the way it is. Usually, as far as I can see, last year, the two trades which everybody basically said, of course, was a lock is buy any kind of bonds, go crazy because that's the trade of the year, and sell yen, right? And what we saw at the beginning of the year, bonds rallied and yen rallied, so people took a little bit of a pain there. So here, those may be a little bit freer to move now. But again, be a little bit careful and don't get yourself in trouble. Now, where are we in the market? Maybe we can look at ES, a general review on ES. So basically, ES, we had this very impulsive move higher, right? And as we said, this is clearly not the kind of move you want to fade into the end of the year. This is a long only kind of move. And as you can see, basically here, what happened is, and it's the same on all the indices, right? But once you take out this aggressive move lower, then the easiest thing or the most normal thing to expect is to see a move right back into the scene of the crime, right? Add to that we're going into Santa rally. The market wants to believe in the Powell pivot, yada, 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 yada. That's a beautiful opportunity to ride long all the way into the end of the year, right? Especially as people don't want to sell into year end. Come into the new year, failure to hold above the 4,800 gives you a chance to trade a little bit to the short side. But right here, the market is still fairly bullish. It's still bulled up, right? So keep in mind that we are going into earnings. A lot of the Fed speakers that were hawkish are turning dovish. We've had talk about Lori Logan, QT tapering, comments, et cetera, et cetera, et cetera. So this is a market that will likely try and find any excuse to continue to grind higher, right? Shorter term, what has happened is we had this last explosive move. This was the FOMC day, right? Without discussing whether the move's right or wrong. That's just what happened. Market breaks through, explodes, comes back. Going forward, you always want to carry forward the reference of that FOMC day range, especially when you get such a big aggressive move. And as you can see is that once we break above, every move back into that range gets bought, right? Gets bought for the rip higher. Now, once we come into the new year and we lose this high, it's game on to play for shorts, right? And the most logical thing after you get that end year rally is to expect the market to come right back down into that FOMC range. Again, acts as support again, bounces, trend move down. Once it breaks inside, The only logical thing to expect is to see it to try and probe the other side of the range. And once it's back inside this range, essentially what you're dealing with is you're dealing with a huge chop zone, right? This is a chop zone. Unless we trade above or below this zone, you have to go with the most recent move. And right now, above is still bigger picture bullish, below bigger picture bearish. If you're looking for those retracements back into 4,600, 4,400, a lot of people talk about that 4,400 level, that move does not become clear unless you start to see daily closes back below the 4,700, back below this FOMC day range low, back below the December settlement price, which you'd expect to get tagged this quarter, right? Above here, the risk is that, especially with the commentary, the market tries to go right back into the scene of the crime. So what I would say in terms of reference points, bigger picture, you want to focus on this as being a big chop range, giving you bullish above, bearish below. And shorter term, as we deal with earnings coming in, intraday dynamics, these 4800s are interesting bull bear line. Now here, if the bears want to make a stand, they need to hold 4800. Here they can start looking at talking about head and shoulders pattern, big correction for a move back down. If they lose the head and shoulder pattern, then it doesn't look so good. You could get another melt up like we saw at the back end of last year, okay? Now looking at a blank chart here, what you can see is this is the move that's in play on the ES. A to B, 50 back gets bought, and this is pointing to extension targets 54,300. Well, primary target 5400, extension target 6100, okay? So this is the move that's in play. But remember that all-time highs are bullish, they're not bearish. So the bears really need to come in and defend this 4800, because above there is absolutely nothing bearish anywhere in any shape or form. And also here, the market is still building. And you could still get a scenario where the market puts in some kind of a double top, comes back down into, that 4,400, and still holds that rotation higher, especially if you start to see more cuts, you start to see more talk about QT tapering, right? You keep in mind that we're in an election year, yada, yada, yada. You have to be careful. There's still a lot of risk to the upside, okay? And if you're looking at some of the other charts you're seeing across the board, like, let's see, like NVIDIA, there is nothing bearish about this chart, right? After it stalled at the end of the summer at this 500, now that it breaks above, this is bullish, and this is going to open up all those targets that people have at the 800, 1000. So you have to be careful, okay? Another way to look at this, we talked about it yesterday in the daily webinar about Apple being a control chart, right? So we've had this nice correction in Apple. And what we talked about was the importance of this 183 level across the board. And what we said is here, this is a beautiful place to look for longs or shorts on Apple yesterday. Why? Because you've got very tight asymmetry, 183 to the upside and the 200 DMA to the downside. Break above, the trade is long. Stop below that 200. Looking for us to pop a lot of gaps to fill. Everybody gets excited into earnings. A lot of upside targets. if we had broken down yesterday, short below, stop above the 183, looking for this to flush back into these lows. Now it's broken higher, but these are levels which you should always be interested in because they give you very nice asymmetry. And right now, as we go into earnings, the risk is that we go back and we fill that gap with a lot of these bullish configurations across the board. That doesn't mean it won't set up some nice shorts, but you have to be nimble. You have to understand that the locations could be interesting for shorts, but right now the market is poised to try and coil higher. Market wants to believe, market wants to rip, election year earnings coming. So we really need a decent catalyst to initiate the short side, also BTC, ETF, et cetera, et cetera, et cetera. So that's pretty much where we are. Another way to look at it, if you want another control chart, is you can look at something like Fangman. And what we discussed here basically is that, even though we had that correction, Apple getting hit, this is still holding this breakup. And as long as it's holding this breakup, this is still bullish rotation. Okay. So you just have to be a little bit careful here. And as I would say, is don't be uber bullish, don't be uber bearish. Just follow price. Price is doing a very good job of guiding us across the board. All the charts are in sync. Action has been fairly nice beginning of the year in terms of intra-market dynamics. So, no need to make it harder than it should be. Hey, Tomic, how's it going? So my take on WTI is that I really don't want to be involved and I have zero interest in trading it. But here we go. The headlines are very messy. And, even though price action looks fairly heavy at times, and it looks like it wants to clip some stops and it wants to cause some pain to the downside. If you're looking at it here, just in terms of geopolitical tension, it's easier to be long than short, if you see what I mean. And look at this weekly. You see how many weeks it's been hovering here, trying to flush lower, but it can't, and it keeps on building on this 200 week. So right now, apart from the fact that I don't necessarily want to be involved, I don't like the idea of holding overnight risk because of the headline risk. Technically, it looks like it's trying to base. It looks like there could be a lot of pain on a stop hunt below those lows, but ultimately it looks like there's plenty of bids trying to support it here. Does that make sense? And the longer this builds, if it can break to the upside, the risk is this kind of move. The problem is it's intraday. It's been extremely messy to trade, but that's the way I would be looking at WTI here. Let me know if that answers your question. Now, another chart people usually ask, so if people didn't make it live, the recording, gold, what's happening on gold? Gold, we discussed the fact that after you got this reversal, this is pretty much a lock. It's extremely rare to not get downside traction after you get this kind of candle, and we got a nice little move to the downside. And here also, it's kind of basing. It's probably going to be down to the Fed. But clearly the chart is not bearish, but it's very hard to get aggressively long against these kind of candles. So I think you need some kind of catalyst before deciding what to do. I would not simply be getting long simply because the seasonals are bullish, right? That's a good way to get in trouble, especially the first couple of weeks of January. But also here, it looks like it's trying to build here to press higher. I think really the big question here is what's going to happen on the bonds, right? And that's really going to likely move everything else. But right here, it's still trying to build at this 10-week moving average, trying to build higher. And if you look at DXY, we're hovering, and right here we likely need to see that next break on ES, right, on stocks. I'm using 103 as the pivotal level. Upside break opens up 106. Current trend move, as long as 103 is defended, is pointing to a retest back into the 100. That's the way I'm looking at DXY. And in terms of yen, what's going on yen? Yeah, everybody came into this saying you had to be short because it's going to be the trade of the year, and that's very likely, but it just doesn't mean it has to trigger straight away. Also, I think is very, very public. Everybody's looking for some kind of rally back into 146 to get short again. So I really wonder if the market doesn't have to take out all these easy trades, right? And that means maybe build here, rip higher, and once everybody gives up on the short, then set up a nicer short from a higher location. But right now, you see what's happening. The fight is on. They're trying to hold this rotation, the moving averages, for extension lower. But this move, the opposing move, is getting bid. So most likely the way to look at this is, how do we trade around this 200 day? As long as the market holds above, the risk is that we need to clear all the people that wanted the easy trade to be short USD JPY for 120. And if we flush below, then it can accelerate to try and take out these lows. But here it's a little bit messy, and I expect it to stay messy until, later on in January after earnings. And you're looking at euro still hovering at this 110, trying to decide what to do. It pretty much toyed with that level all of 2023. And here the question is essentially, if the Fed is going to continue talking about cutting and Lagarde is going to continue talk about, not cutting, inflation picking up again, the no-brainer trade is to stay long Euro USD for a break higher as that DXY comes back down. But, it's really hard to get. It's kind of like gold, right? It's kind of hard to get aggressively long into all these failures, even though it is trying to build. That's why I think the far nicer trade here is to be tactical, trading those equities, which would be moving very nicely, very, very nicely. And once we get the next catalyst in terms of data, the next catalyst in terms of, whether it's central bank or earnings, then the dollar should join in. But for now, it's just chop waiting for one of these other catalysts. Okay, no questions today, so let me see. I'll shut it down early if there's no questions. Let's look at some other charts which are interesting. Another thing I'd keep an eye out for also is, again, the bonds in general. Remember, the trade everybody was looking for going into the year was to get long bonds, any bonds. You're going to make money. So here the big question is, similar to what we said on some of the other ones, does this have to stop out a lot of those bond longs before going long, or is there more downside? I think what would likely catch most people off guard after this rip and everybody spent the back end of the year getting long bonds is to see this try and flush back here. I think ultimately, unless something big changes, you'd expect the low to be in. Famous last words, right? But maybe, again, we need to retrace lower, 50 back of the most recent move, confluence of this moving average before heading higher. And again, I wouldn't be surprised if unless we get a clear picture in terms of data back to back, strong or weak, or from the Fed. We look at this whole range, kind of like with the 100 DMA here and the 10-day moving average, or this recent high, as a huge chop zone where the market just trades around waiting for the next big catalyst. And that goes for all the bonds. Another chart which I think is interesting and I'd be keeping an eye out for is DBC. Here I know a lot of people want to get long commodities. What I would just say is focus here on this location, right? This is a huge level, huge level for DBC. And this is the kind of zone where you have asymmetry. What does that mean, right? Is that break and hold below. This gives you very nice opportunity to play for a continuation of this trend move lower. Holding tight stops. You can see if this move is for real, it'll probably hold the 10-day. Maybe you can trail something a little bit wider. You could trail it 20 DMA, something like that, 21, but that should hold if the move's for real. But equally, if we get some kind of catalyst and you get a sharp reversal and this closes back above this previous low, back above the 10-day moving average, this should open up an interesting, even if it's a corrective move, an interesting pop with fairly tight risk once this set up. So I think this is another of those charts which I think are very interesting, and I would be focused on. I don't know if anybody has any comments or any questions, anything they want me to look at. More than happy to cover any chart anybody wants to look at. If not, I'll just call it a day, because I think that's pretty much where we are. There's not that much more to discuss. But again, market's been fairly nice. The action, a lot of things have been in sync. There's really no reason to get in trouble or be bullish or bearish or have a strong bias. The market's been telling you what it's trying to do, how it's doing it. A lot of things are in sync. You just want to be very patient. Okay, guys, looks like no questions. So call it a day. Wishing everybody an awesome rest of the day, awesome week. Catch you guys soon. And again, if you like these sessions, remember to like it so I know it's worth me doing these, okay? All the best. Take care. Bye-bye.